Principles of Finance, a la Shmup. The logic of balancing a sheet. All right, well, you tasted balance sheet light earlier in this course, and now we're going in for the heavy French reduction sauces. You know, the cream ones. In case you have the memory casing of a goldfish, well, we're reprinting the skeletal bones of the balance sheet from earlier right here. Now, here's the balance sheet for Lemonade Stands Are Us 3 days before the Super Bowl kickoff. All right, skim through the numbers, skimming. Let's take a little tour down balance sheet lane and figure out how we actually apply these terms or concepts. Well, the first lines actually begin to tell the story of our little company. It was capitalized with a loan from Grandmama that was originally granted as a 1-year loan. Today, it's something less than a year because it's current, i.e. the principal of $5,000 is owed within the next year. And we also note that $3,000 of that $5,000 has been burned. We needed to build the stand, buy stools, and all that jazz. Well, keep reading and we find the $100,000 peg. That's a lot of dough. Well, the NFL promised to pay us $100,000 if we delivered 100,000 cups of lemonade to the game, but they're not paying us up front, so we have to front the cash for all the supplies, and yeah, that's risky. The NFL could fire us at the drop of a hat, and if they do, we're bankrupt and then some. We'd never be able to pay back our Visa credit card bill, Grandmama, and the cups vendor by just selling lemonades in front of our house at our stand. All right, but if we do make this deal work, it, quote, makes us, unquote. We'll have massive profits and be able to open 5 more lemonade stands, so we roll the dice, as it were, and pray a lot, and hope for hot, thirst-inducing weather. Yeah, pro-global warming. Screw the polar bears. We really don't have any other assets at this point as we're skimming. There's no brand value for our lemonade. It ain't Country Time or Minute Maid or Grandmama's. It's just a name worth squat at this point. Note that we have $0 in long-term debt. If Grandmama had given us debt due in 3 years, well, then it would live in the long-term line, not the current one. And note that our long-term assets are PP&E. Plant, property, and equipment. And in this line, well, the item is held as net, not gross, usually. What does that mean, net? Well, we said we'd burned $2,000 since starting the company. Yes, we've had sales and we've also had expenses, but we've basically been running close to break even thus far. We spent $1,200 on stools and stands 6 months ago. That's our gross value, and we figure they'll last 3 years and then break because someone will sit on them or play with them after hours, and we're not watching to yell at them. So we think that the $1,200 original cost will be worth 0 in 3 years and that it will decline in value arithmetically in accordance with how most things like furniture are depreciated in accounting land. So if it goes to 0 in 3 years, then every 6 months, well, it'll decline in value by 1/6. Well, 1/6 of $1,200 is $200. So we took $200 off the value of the $1,200 we started with and now hold the value of our stools and signage as $1,000 on our balance sheet. So how do we best disclose these moving parts on the balance sheet? We show our work. We have a line for gross PP&E, that'd be like $1,200 in this case, and then we have a line for depreciation of PP&E, like $200 there, and then like a line of net PP&E, and that's like exactly our grand. All right, get it? Got it? Good. Note that we could have accounted for this depreciation value in other ways. We could have thought about it like, well, our signs and stools are worth $100 today on eBay. If we ever went out of business, like if the NFL punted us tomorrow, well, the signs and stools would get liquidated on eBay, and so we should carry them today at their liquid value. Yeah, not a stupid idea. Sorry, that was a bad voice. We won't do that again. In reality, that logic is actually closer to the religion of GAAP than not, right? You want to be the most conservative that you can that's realistic. However, there is one mitigating factor. We're not dead yet. That is, at this moment anyway, life is looking bright. The odds of the Super Bowl happening are high, and if it goes through as planned, we make bank. So since we are healthy-ish, we don't need to depreciate everything suddenly to just being liquidation value, like that $100 thing on eBay. Should things change, however, we'll want our finger on the red button to bring those values down fast. Hopefully we don't have to do that. It's not pretty. In the same vein, note the little note on inventory that it's held at cost. Well, we'll have paid a dime a cup for the massive cups, but if we had to turn around and sell them again on eBay or somewhere because all sales from Cups R Us are final, then we're likely to get less than a dime for them. So shouldn't we hold the value of that inventory at less? No, because we're still a going concern, doing just fine, thank you very much, and we're optimists at heart, and that's why we're entrepreneurs and not, college professors or government workers or something. So let's take a pause here and add things up thus far in our little history. On the left, we have $2,000 in our Bank of America account, $100,000 in accounts receivable. We've billed the NFL. They've promised to pay the week after the Super Bowl. We have $15,000 in inventory, $1,000 in equipment, the E of PP&E. All of the left side totals $118,000. Okay, Alex, the right side for $500. All right, well, we have $5,000 in short-term debt. Tick, tick, tick. It's coming due soon, and Grandmama will send the baseball bat boys if we don't pay. Yeah, she's a tough old bird. $10,000 payable to Cups R Us, $5,000 owed on our Visa card for buying sugar and lemons at Costco, and well, that's about it. So on the right side, we have a total of $20,000. Oh wait, that's not balanced at all. Isn't the right side supposed to equal the left like it does in the contested political states like Ohio and Florida? Yes, it is. Well, what's left is shareholders' equity. Well, how do we get there? Well, we just subtract the liabilities from the assets and we get $118,000 minus $20,000 equals $98,000. That means our company's worth $98,000? Well, yeah, kinda, sorta, at least shareholders' equity is. There's one more wrinkle we have to digest first, the equity of the company. See, that was the easy segue there. If you watch the opening of the sauce company and you don't have short-term memory issues, well, you'll recall that in order to capitalize the company, to form it financially, the founders wrote a check for a very small amount of money to buy common stock in their own company. In this case, let's say that our lemonade stand business is capitalized with 10 million shares at 1/100th of a cent each. Why so many shares and why so cheap per share? Well, we're glad you asked. The high number of shares allows us as a founder, CEO, financial manager to grant shares to employees who want to come on board later and help us grow the company. It also lets us not have to sell fractions of a share as we find other investors who want to put money into us. For example, if we capitalize the company with just 10 shares at $100 to start, well, then we'd write a check for $1,000 to capitalize the company. But what happens if we do really well and, in a year an investor is willing to give us a company valuation of $1 million and they want to buy 5% of the company for an investment of $50,000? Well, we'd have to sell them half a share, and yes, that would be a pain. And the tiny amount per share reflects a few things here. First, that we are not rich and don't have a ton of money to capitalize the company properly with an injection of $100,000 or more of our own money. We're tiny. And second, that our common stock sits behind pretty much every other class of stock that other investors would buy in our company. If things go poorly and we have to sell, well, the banks get paid first for their lines of credit, like Grandmama. Then the bondholders get paid. Yeah, that's the Grandmama thing. Then the preferred stockholders like venture capital people get paid. And then at the very end of the brown rainbow, we get paid our common, which is likely a whole lot of nothing. So we don't want to have a ton of financial exposure to common stock at this point via our hard-earned cash savings. We'll own 100% of the common stock on day one anyway. We're the sole founder here. So with 10 million shares at 1/100th of a cent each, we've written a check to the company for $1,000. Note that the notations then under the shareholders' equity lines, our retained earnings are $97,000. Yeah, that's a lot, an enormous value we've created in a short time. Thank you, Super Bowl contract. If the Super Bowl goes well and we actually get paid, we're styling. All right, when you see the word other, you should split your brain in half. Half of it should just ignore the term, and the other half should get all uptight about it. All right, here's to the uptightness. Note that other comes up a bunch in all flavors of statements: income, cash flow, and balance sheets. Note here that other short-term assets could be things like prepaid rent or prepaid insurance or prepaid power, gas, and electric bills. Dicey startup companies are often asked to pay for things well in advance because war-weary landlords have too many scars from small companies sneaking off into the night and not paying the rent they owed last month, right? But think about how prepaid rent could, should be, is an asset. And it could be long-term and short-term, right? You have 3-year prepaid rent on a place for $3,000 a month, 36 months. You were funded by venture capitalists, and at that time you were swimming in cash. The time, when you set the rent deal with the landlord. In order to get into the best building in town at a nice discount per month, you had to pay all 3 years of rent in advance. That's 36 months times 3 $3,000 or $108,000. Well, at the moment you signed the lease and paid the dough, you had a short-term or current asset, 12 times $3,000, $36,000, that was current asset. Got it? And a long-term asset of $72,000, the remaining 24 months, a year or more later at $3,000 a month. All right, as the first 24 months went by, the value of the long-term asset gradually declined to zero, and then when there was 1 year left on the lease, it was $36,000 as a current asset. Well, funky things happen in big bull markets with regard to rent as well. Oftentimes, if long-term rentals happen at the bottom of a bad market, the value of the real estate goes up a lot as time goes by, and in theory, companies could, quote, flip, unquote, their leases to the market, which was paying $3,000 a month, but currently would be happy taking over the lease for $5,000 a month. In theory, companies could mark to market a gain of their current assets in the rent lease thing, but since they almost never intend to move out of their offices during the time of their lease, and moving costs are usually really high and a pain, they just leave the numbers as they are. But you should know about all that stuff, so you get all this information from Shmup for no extra cost. What a deal. All right, liquidity is a hugely important concept to understand and be able to apply as well. It's such a big deal that balance sheets are organized under its auspices. Note how our balance sheet is laid out. Cash comes first, then accounts receivable, then inventory, then other, think prepaid rent here, then long-term assets like PP&E, and lastly, other long-termers. Did things happen in this order by accident? No, not on your life. They're organized by liquidity, and there are really two reasons for that. Well, first, should the company have to be liquidated, the easy-to-sell stuff is almost always the most liquid stuff, and second, the values of the more liquid stuff are way tighter, meaning if a company has $83,231 in cash in the bank, well, that cash is worth $83,231. Very liquid, very precise, not a lot of debate, no worries about conflicts of interest in selling that cash or transferring it or whatever. It's worth what it's worth. But what about a 14-year-old tractor smelting plant or a 22-year-old newspaper printing plant? Well, they both still function, but what are they worth on eBay? The company paid $1 million for the printing plant 22 years ago. Is it still worth the million? Well, prices have gone up a ton over that time with inflation. Printing plants are rare. Maybe the parts are worth a lot. Or is it just scrap metal worth $10,000 waiting to be hauled away at a price and then melted down? Very wide range there. Low liquidity, low precision. Anyway, if you think about it, cash would be super easy to liquidate. An account receivable would be like collecting from the NFL the dough they already committed to paying, assuming the company performed on delivering that service, the 100,000 drinks, and in order to show it as a receivable, the service would have had to have been performed and delivered, then collecting from the NFL, well, at that point should be very liquid. Yeah, it may take 30 days, but it's a pretty clear and safe bet to happen. The NFL pays its bills. All right, then we go to inventory. This is harder. Who's going to buy 1 million cups and 5,000 pounds of sugar or whatever amounts you have on your books when you go bankrupt? Well, tough to sell, so the numbers get vague here really fast in the form of the value you are carrying that inventory at, book value, or what you paid for it, versus what the market will actually pay for, used sugar. What would they pay you in cash to buy all that? Used cups, anyone? Yeah, we think not. All right, the others follow similar suit. A 4-month tail on a lease ain't worth much on the market. It's the league of the 22-year-old newspaper printing press thing, not at all liquid. Big discounts, big write-downs at bankruptcy time, and maybe big bargains for whoever is in the market to buy a slightly used newspaper printing press. All right, let's go back to our balance sheet's most recent iteration, and now look at this newly updated one as of this morning. Well, so what happened here, people? Well, the Super Bowl happened. Green Bay won 42-3 on a mercy field goal for the other team at the end. The NFL paid, the inventory was used, Grandmama's loan was fully paid off, so the liability of $10,000 to the cups vendor and $5,000 to the Visa card and everything else, it all adjusted. Now, how much cash is in the bank? Well, a whopping $82,000. The value being held for the stools didn't change, still about $1,000. Everything else evaporated. And note that the shareholders' equity here is $82,000. That is more or less the company's entire book value. But a company that just generated such enormous pre-tax profits in such a short time has to be worth a lot more than $82,000. $50,000, right? The market value of the company is a reflection of what an outside investor would pay for a given percentage ownership of the company. If you were thinking about raising capital at this moment with such a great business momentum going, well, it's probably not a bad time to raise that capital. There's one key and very important liability missing in the above sheet. Any guesses? Right, rhymes with schmacks. Yep, tax. Well, you just made 50 grand and change in profits. You think the G-Man is going to let you keep all that money? Guffaw, not gonna happen. So if you live in a blue state, assume you'll pay about 30% of that 50 grand in taxes, and well, you should plug a $15,000 current liability of taxes payable here, so it's obvious you're thinking about it, no matter what kind of nightmares it gives you.